Hey, Market Chameleons. Thanks for joining us and holding on there in YouTube chat and waiting for us to get started. It always is
Good
a little
morning,
bit of
everyone.
AD. It's a little bit of an adventure.
Good morning,
Before we get started, remember any questions, pop in the YouTube live chat. We are running this through Zoom. I put a link there. If for some reason your screen is a little fuzzy, which sometimes happens in the live feed, just go to the Zoom link and that will put you into our Zoom webinar, and you can ask questions there in the chat. Remember to like us and subscribe. You'll get the pop-up and alerts to any new videos, and when we go live in the morning, always useful. With that, Dima, you want to get started?
Yeah, sure. So let's just put up the disclaimer really quickly.
The disclaimer.
As usual.
Hold on.
So I was going to pop that up. So everybody, keep in mind, we are not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need the advice of a professional, then either seek out an investment advisor or call your broker. So there's the disclaimer real quick.
All right, let's get started, Dima.
Let me just share my screen again. Okay, and just let me know if you see my screen well.
Yep.
Okay. And as usual, we're just going to start again really quickly with what's moving in a pre-market. We'll look a little bit at the earnings or upcoming earnings and what's going on there. After that, I was going to go to SPY and look at a couple benchmarks and look at a few different strategies we could look at together and put them in a payout diagram. If there are any questions, I'm going to leave some room for questions, and Will, you let me know if you see any questions popping up. So again, if you guys are just joining us for the first time, this is the pre-market report and stocks trading in a pre-market, actively trading. We have it broken down by most active, largest percentage gainers, largest percentage decliners. And usually I'll just go like to one of the top ones on a page. And a lot of times they're smaller market cap stocks, but just as an example, we'll just pop one open. I think that we said which one we were going to talk about, HUGE.
Yeah, HUGE is a good one to start.
Let's do that one. I'm going to pop this one open, and this is what's going on in the pre-market. So yesterday it closed at $3.74. The stock now is trading in the pre-market $7.14. That's up 90%. Here's your 52-week range, 239.14. So it's still within there. We see that's trading 3.6 million shares on the day. I'm sorry, in the pre-market hours. This is what the graph looks like, and we see that in the volume, in the VWAP bars, that the bulk of 750,000 shares traded between 898 and 963. So that's like the biggest VWAP bar over here. We got some set. The next one is 770, 834. I went down here. There is some kind of a catalyst news here. I didn't really go into reading it or interpreting it, but there, it is a small biotech stocks. You could see here something with COVID-19. Didn't open it up. I'm just looking at it from perspective of price action alone. Let's take a look at historically what the stock did on big gap moves to the upside and what transpired, during the day after the opening. So this here in the last 3 years, we're looking at the biggest 12 gap moves to the upside at the open. And here are the gap moves here. These are the dates. And these are the notes are just telling us if there's some kind of a press release associated with that move, or maybe it's just moving up with the rest of the market. When the market gapped up, it also just with sensitivity to the market, it also gapped higher. So in the last 12 quarters, if we take the average of the gap moves, it's 43%. So we could see very big moves. It's made very big moves at the open historically. We see this one, 351% in June 3rd. So we see here even June 3rd, June 5th, June 16th, very recently, it's been making big moves. Today, it's compared to 90% so far in the pre-market. The other thing, just what I'm observing here is that from the opening price to the high, the average has been 0.3%. And from the opening to the low, the average has been 16.1%. So at least from a historical perspective, according to these observations, on those gap moves, it tended to open near the high of the day. So you could see there wasn't that much after the opening so far in these last 12 quarters. And you could see here, these are saying that the opening was the high price of the day. That's what these zeros are. From the opening to the close of the day, we see that 92% of the time it drifted lower for an average 14.3% decline. So this is looking at it from a historical perspective. Also keep in mind, whatever this news is today, take a look at it. There could be something's different about it, then you have to take that into consideration. But this is just a fast look at the price action analysis. One thing I did notice also is that a lot of these gap moves that we've been looking at in the morning tend to be small cap biotechnology companies. So I wanted to go look, well, what tended to happen in the small cap biotechnology companies that gapped up in the morning in the last 2 weeks. So over here, what we're seeing is these are the gap move in the last 20 days. These are all the stocks that gapped up in the morning. So if we just took all of them, there's 2,840 observations. We see that 50% of them from the opening price increased by 10 o'clock, 49% of them declined, 1% probably unchanged, for an average of negative 0.1%. By the close, from the opening to the close, remember, they did the gap move from the opening to the close. 44% of them finished higher, 55% of them finished lower, for an average of a negative 0.3% decline. So that's our control group. That's all the observations in the last 2 weeks, stocks that gapped up. So let's take a look at, I'm going to do just biotechs. So let's see if the biotechs behave differently than the entire group. So I'm now selecting biotechnology companies. Let's look for stocks that had really big gap moves. So I'm going to pick above 20% at the opening. So anything 20% or higher increase in share price at the opening. And let's look for market caps. Let's just look for, let's see what this is. So these are small market cap stocks. So let's take a look at, market cap stocks under 100 million. All right, so we see there's not that many of them. I think we have like 6 of these in the last 2 weeks. Let's expand it to under 500 million. All right, so under 500 million, we have 21 observations. So let's just compare that to the entire group. So we see that 43% of them after the open went higher, 57% of them went lower after the opening by 10 a.m. But keep in mind, look at those percentage gains. On average, they gained 4.8%, which is telling me the ones that went higher went much higher than the ones that went lower, right? So that's these. So we see some of them, you could see that this one added 107% from the opening price, opened up 81%, gained another 107%. This gained 64% at the open, gained another 40%. So what it's telling us is that the moves to the upside tended to be greater than the moves to the downside from from the open to 10 a.m. To the close, kind of same story here, that only 29% of them increased from the opening price to the closing price, compared to the entire group of 44%, 71% decline versus 55% to the control group. But we see here that the average from the open to the high was 3.3%. So some of these moves to the upside have been very violent. So keep that in mind when, at least in this particular group and given these parameters. Let's go to, let me see if I made any notes on any other ones. Maybe we'll come back to it, but let's take a look at what's coming up, what's upcoming up in earnings, and then we'll go kind of to SPY and take a look at maybe a potential strategy in SPY. Will, unless you have anything Anybody asking about this pre-market? I'm going to move on to earnings.
Yep, you can move on to earnings, buddy.
Okay. All right. So first, let's look at the earnings calendar. I'm just going to take a look real quick what's been reporting before the market opens. So these are stocks that today are reporting before the market. So we see here Procter & Gamble reported. That's up 1.5% in the pre-market hours. The move that was expected according to the option straddle. Remember, this is the expected move in either direction, up or down, 2.5%. So that's what we're comparing it to. 1.5%. It's up 1.5% compared to an expected move of 2.5% up or down. MasterCard, that's up 1.4% in a pre-market versus an expected move of 2.8%. Comcast, that's up 2.5% versus an expected move of 3.5%. Eli Lilly, that's down 2%, expected move 3.3%. So those are the ones, four top ones, and you could go down the line. But let's take a look today, what's coming up after the market close. So we see some big ones today: Apple, Amazon, Google, Facebook, Gilead. So you could see a few really big names here. These are what we're expecting, the market's expected move according to the closing option straddles prices as of yesterday. So we're not open yet today. These are based off closing prices as of yesterday. Apple is expecting a 4.1% move in either direction. We could see here last quarter it was down 1.6%. This is the previous earnings move. Amazon is expecting 5.7%. Last move, it was down 7.6%. This is, again, these are the magnitude of the moves, not direction, but magnitude up or down. Google is expecting 4.6% versus previous move of 8.9. Facebook, that's expecting 5.9% move up or down versus last quarter, it was up 5.4%. So something interesting here is these are the big tech stocks. Two of them were lower after earnings last quarter. Two of them were higher after, so they don't always follow each other. You can see it's kind of a mixed bag there. Let's just compare that. Let's look at that versus the 12-quarter average. So here, Apple right now, like we said, the expected move is 4.1%. In the last 12 quarters, the absolute average move is 4%. So that's kind of like right in line for its historical actual average moves. Amazon, right now we're expecting 5.7% versus a historical average of 4.7%. We see here that high move was 13.2% last 12 quarters. For Apple, high move was 6.8%. Google, right now we're looking at expected move 4.6%. That's really in line with its historical 12-quarter average, high move of 9.6. Last one, let's take a look at Facebook. Right now, that's implying a 5.9% move in either direction versus a historical average of 6%, right in line with a max move of 19% in Facebook in the last 12 quarters. So that's really quickly looking at from the perspective of moves. We could take a look at how the strat. Do you have any questions coming up? Because
it's just someone mentioned, it's just interesting that these three tech stocks who were just in front of, the government talking about, anti-competitive behaviors, whatever. Yeah. And they also have had they've basically led this run up into we have a pandemic going on, right? Terrible job numbers.
Definitely.
I drive down Main Street here, 4 out of 5 restaurants are still closed or either opened and now reclosed. I mean, it just seems, these have had such a major run up. I mean, it's just interesting to me looking at this quick analysis that the expected move is right close to the average move. Like, one little faulty number in one of these things seems like you could have a bigger move.
Yeah, that potentially you could have a monster move.
It's just interesting that they're all priced right at their average move in the midst of everything that's going on. It seems interesting, but
definitely. And I did know, let me just take a look at Um, I know that they've been rallying and really leading the market higher, the tech stocks, but I think I'm just going to take a look at my watch list really quickly and just look at the performance in the last 2 weeks. And, I did notice, see the technology sector, at least in the last 2 weeks, has been really cooling down. That's off 0.5%. We've been rallying, right, in SPY. That's up 1% in the last 2 weeks. So, of course, they have been leading in the last, really been leading the market higher, but it seems like they've been cooling down, at least recently in the last 2 weeks. Them communications, let me see what's kind of taken over. Like real estate started to pop, and which has been lagging, right? Utilities have been lagging the last 2 weeks. They've started to come back. So maybe we're seeing some rotation. Maybe they just got valued so high that some people are so far ahead that it just looks to me like, money's kind of just starting to move around, just starting to kind of move around from one sector to, they're just taking some off the table, moving into like the weaker sector. So you can see here, year to date, real estate, utilities, they're down, year to date. So that's just one observation that I did notice in the last 2 weeks.
Looking at these 3 tech titans or 4 tech titans, someone is asking, what are some of the option strategies that are popping up around their earnings? Is there anything that's showing up on our trading cards in those?
We could, we could take a look. Let's take a look at those. Let's say, let's take Facebook. Let's just take one for now. And well, instead of the trade, let's just take a look ourselves what's happened historically in Facebook. So we see here that Facebook, the markets have overestimated the move 67% of the time. So 2/3 of the time, the straddle was priced higher than the actual move. The average of all the implied moves in the last 12 quarters was 6% versus an actual of 6%. So really, it's been kind of in line, on average. Here, this is kind of showing these bars. They're showing what the estimated move was going into the earnings. That's what the blue bars up or down. The green ones are the actual moves, and the red ones are the actual moves. So here you see the green is within that bar. Here, the stock moved up 5.4% versus an estimated move, up or down move of 6.6%. So we see here that had a couple that kind of just busted through that implied straddle, and we see the big one here is to the downside, down 19% on July 25th, 2018. But this is how the straddles did. And I'm just looking, maybe this one had a really big impact on it, this one outlier. But the long straddle, that was only a winner 33% of the time. If you bought the call and put at the money straddle the day before, so the day after, it was profitable only 33% of the time, but the average return was 9%. So that could be because of this one move over here, right? It's a big outlier. The long strangle, buying the out of the money call and buying the out of the money put. So that's when you're expecting a very big move, but you want to spend less on premium than the straddle. So that was a winner also 33% of the time, but it had an average return of 23%. Credit iron butterfly, that was a winner 45% of the time for an average return of 1%. Credit iron condor, that was a winner 73% of the time for an average return of 12%. So this is kind of like how based on those movements. And let me just see how the stock tended to perform Facebook. So we see here on the opening gaps, 75% of the time it opened higher for an average of 1.9%. The average absolute move at the open has been 6.6%. So up or down 6.6%. at the open. By the close, it was the average move was 6%. So what it's telling me is that whatever that gap move was, historically tended to close a little bit. So it didn't expand, it kind of tended to close because the magnitude of the move at the open was higher than the magnitude by the end of the day. And we see here that it tended 75% of the time it opened higher, 58% of the time from the opening price it drifted lower for an average loss of negative 0.6%. From the open to the high, we see the average has been 1.7%. From the open to the low, the average has been 2.2%. So the other observation maybe I see is tended to coming out after earnings. It was kind of a mixed bag, but a little bit weaker, right? So that's what we see is tended to give back a little bit of the percentage in percentage shares. Heading into earnings, though, tended to do pretty well, right? So tended to have run-ups into the earnings, 1 week, 3 day, 2 day, 2 weeks, they look on average, they look positive to me. So that's just like kind of a quick overview. One other thing, let's just take a look at implied volatility, how that behaved. So this is looking at Facebook on a 30-day constant maturity. So an option that has 30 days to expiration, not the near term, but 30 days out. And on average, after it reported earnings from the day before earnings, day after, implied volatility declined 26%. So we could see day before the average implied vol was 35.4. Keep in mind that's 30 days to 30-day constant maturity, 30-day expiration. Day before 35.4 to then drops next day to 26, 5 days coming out, right, 25.7 on average. So that's how the implied volatility tended to behave historically, day before earnings to day after. Let's take a look at SPY, unless, Will, you have another one?
Well, and it's in the earnings. There were 2 earnings questions. Edward the Willing, he's one of our longtime watchers. He was asking about the oil stocks, and he knows Exxon and Chevron are reporting earnings tomorrow. And then we had another UPS earnings question. So if you're on earnings, we still want to go back to earnings.
We could stay on, sure.
Yeah.
So is what's Exxon? This one, XOM? Yeah. All right, so that one's, tomorrow before the market opens. So let's just take a look at what that tended to do. So here's the historical behavior. So these bars here, that's what the options were implying, the move, the blue bars. The actual moves are in a green and red. Red, it was down move, green, it was up move. So here we see that, to me, it looks like it broke through the implied move a lot, and let's see that Exxon, it overestimated the move only 33% of the time. So it underestimated it 2/3, right? That average implied move prior to earnings, on average, it was expecting a plus or minus 2% versus actual historical average of 3%. This is what the long straddle did. It was a winner 75% of the time for an average return of 38%. The long straddle, that was a winner 50% of the time for an average return of 46%. Credit iron butterfly, that was only a winner 25% of the time for an average loss of 51%. Credit iron condor, that was a winner only 36% of the time for an average loss of 45%. And let me just take a look at the implied volatility crush. So here we see that the implied volatility tended to come in about 10%. So there wasn't probably that much already priced into that, into that stock. So on average, it declined 10% after the earnings were announced. On a 30-day maturity, it was on average, the implied volatility was 21.1. Day prior, day after, it was 19.3. So let's look at that since we're on it, all right? So let's find, so So this is close to 30 days out, right? Oh, here, 27 business days out. So let's just say we look at the straddle here. So let's say this is the straddle. Sorry, so I'm going to do it from the sale perspective, all right? So this is just for demonstration, guys. Don't go out doing it. We're just going to take a look at it from just an example. So if you sell that straddle at the money right now, the credit, you would get a credit of $3.97. That's your midpoint, 421. Again, that's important. You always want to get as close you can to the midpoint. The further away you go from the midpoint of the market, that's kind of like you're giving up edge.
That's your toll.
Trade. What's that?
That's your toll to enter the trade.
That's your toll to enter the trade. Exactly. That's your fee. So from 421, 397, you see you still have like 24 cents. You know, that's a couple percentage eats into your return, right? So keep that in mind. Always look at where the midpoint is. Try to get your execution closer to the midpoint than right on the market. So this is the straddle here. So this green is at expiration. This is everywhere that you would profit. If the stock goes above it, right? It moves more than this implied straddle, then you start losing money here on the call side, and you keep losing as it goes up. On the put side over here, you keep losing it as it goes down. So really it has to remain in that range for this trade to be profitable at expiration. So let's just take a look, and this is what I'm going to do. First, let's move. I'm going to take the last 12 moves, right? So here, what these lines are is this is what the stock percentage moves it made after earnings. So we could see here right now, this straddle, at least on a 1-day percentage move, that's covering all these moves. So that's 12 moves here, up 3.6%, up 3%, 1.6. So right now that straddle is covering it, but remember that's 30 days to go. So that's just a 1-day move. Let's see what it looks like if we selected, when is it reporting? July 31st. So let's say, is that right? July 31st. So let's say, what does this straddle look like on, let's do August 3rd, right? So that's this blue line here, right? So that's this blue, remember it's not, that's what we're looking at the day after. And let's change this and say that this is going to decline by 10%. So what is that like? I'm going to move these down. Let's move it down by 3. It's like 3.5. I'm going to move it down by 4 clicks. So let's say this is the new implied volatility. I moved it down a little bit more than 10%. Now let's reload it. And on August 3rd. So that's that blue line. So you see here, that's where you're profiting, that blue line down here. Let's put these back on, 12 quarters. So here you see that a couple of them are falling outside, right? So a lot of them are falling within that range over here, a couple of them falling outside. So that's how you would look at the moves with implied volatility. But again, if you're afraid of those wings, right? This is the strategy. You could convert it to a butterfly or even an iron condor. So the butterfly would be, I'm going to buy, let's say, buy a wing over here. So what did I do here? 1.4%. Wait, how did I get to? So where am I? Like here. So this is what. Is
that a broken wing butterfly?
Yeah, let me do.
Hey, while Dimitri's going through his broken wing butterfly, make sure you register for subscribe to the YouTube channel. And it's always nice to get a like. That's always nice. If you're on chat right now, It's good to see everyone. We only got a few minutes left. If you have any questions, maybe for the next show, put them in and I can get that to Dmitry.
Yep. So that's just kind of a quick overview of the XOM. Of course, there's a lot of different strategies you could do. This would be a butterfly. There's calendar spreads that are popular. Iron condors are popular. Diagonal spreads are popular. So you'd have to kind of go through each one and test it out. Considering the historical moves, historical implied volatility crushes, and see how those odds play out from today's prices.
A couple quick questions, D. This is a theoretical question. Stock, you're long that it's at the money, or actually the brokerage firm is now saying to the customer it's in the money. He's long the 50 strike, expiring tomorrow. It closed yesterday at 55, but in the pre-market this morning, the stock's trading at 40. Is it still in the money?
No, it's not in the money anymore, right? Yeah.
Just because your brokerage firm is basing it on yesterday's close, where it's trading now, you don't want to go out and exercise the 50 strike.
If the stock is at 40, right, then that 50 strike's already out of the money. All right, the stock's at a new place. So really, it's only in the money. That strike is constant. The stock is moving around, so it's only in the money if the stock is above the strike. If it's below the strike, it's out of the money.
What your brokerage firm is telling you is in the money. They're not going to give you that stock price. The stock price you're going to get is what's live in the market. Just be aware.
They're just marking it to either to the close or to a previous price. But you have to look at the current markets, because it's where the stock is at the time, right? And really, the only times you would exercise the call is if it's deep in the money, right? Because if you could, here's ExxonMobil, it's $44, right? So even this 40 strike, right? 40 strike, that's in the money. The stock's already above 40, so it's already $4.03 in the money. But if I exercise it, I buy the stock at 40, right? And it's 40.03. But over here, just selling the call back out, the bid is 415, maybe you'll get 430. So there's premium in that option. So you wouldn't want to exercise a call that still has premium in it, right? Because the better deal is just to close out of the call.
We're getting flooded with questions. I got one. I promised Asif, who's been on every morning. He just wanted to go and look at the gap history for a particular stock, EDSA. If you'd be willing to do that, that'd be super helpful. I mean, we only got 5 minutes left, but I wanted.
EDSA.
Yeah, he's been I think since we've been doing this show, I think it's day 9. He's been on every morning, so I'm trying to.
So like a gap up history?
Yeah, he's looking at the gap up history.
Yeah.
I don't know.
So here's the gap up history for this stuff. EDSA, is this correct?
Yes.
It's up 200%. So this is the historical gap up history, and we see like here even some recent ones, June 15th, June 1st. This is in the last 3 years, the biggest 12 gap moves. So we've seen like 140 recently, 179, but the average has been 34%. From the opening to the high, we see on average it's gained 13.9%. But look at it's pretty volatile, right? Like you have small moves, high moves. So keep that in mind that there's a lot of volatility in there. The average to the high is 13.9%. Average from the open to low is 12.1%. From the opening to the close, it tended to drift lower 75% of the time for an average loss of 5.5%. This is just looking from a historical price perspective. I don't know what news is driving it, so you always have to take a look here, because here it's up 200%. 50,000, it looks like on 50, let me see here. what's the volume here? 7.7 million. So that's a lot of shares trading hands. Just take a look at whatever the catalyst is, you know, before you make any type of, you always have to put that into consideration. That's your trader, you know, responsibility.
That's your role. That's your role as a trader.
That's your role, right? But that's where it is here. And like, I'm just looking at in the 52 weeks, it's been $1.58 to $10. It's already, you know, busted way through that. Let me just see if I could, you know, we see how quickly it's been. These are minute to minute VWAP bars from 903. So we see how quickly, you know, it could just move, that it moved higher so far. And here's the, you know, here's the low high for minute to minute VWAP bar. So just here alone, you know, I'm seeing like ranges of between 60 cents to almost $1, right? So just within a minute, that's how liquid it is, you know, that it's trading in, and you know, this is $16 stock from low to high. You know, you could see here, you know, 60 cents, you know, this one's almost $1.77. Very, very liquid stock. So keep that in mind, right? That a lot of illiquidity in that stock.
Awesome, D. Listen, I know we didn't get to all the questions. We'll always try. Email us at support@MarketChameleon.com. If you have any questions that weren't answered today, we'll try to get to them on another show. Dima, great job as always. Thanks so much.
Thanks, everybody. Thanks for joining us, and hopefully we see you guys tomorrow.
All right, we'll see you tomorrow. Have a safe trading day, everyone. Bye.
Bye.